Welcome to AM Best Audio.
As climate risk, cyber threats, demographic shifts, and geopolitical volatility intensify, the global insurance industry faces a widening gap between economic losses and insured losses. In its latest report, Addressing Growing Protection Gaps Through Better Public-Private Collaboration, the Geneva Association examines how insurers, governments, and regulators can work together more effectively to close these gaps and strengthen societal resilience. Joining us is Hélène Schernberg, Director of Public Policy and Regulation at the Geneva Association, to discuss the report's key findings. Hélène, so glad you could join us today.
Thank you, John. Nice to meet you. Glad to be here.
Great to have you as well. So to start with, what do you mean by growing protection gaps, and which gaps are most concerning today?
So as you've just said, the protection gap is the difference between the total economic losses from a disaster or a given type of disasters and what is actually covered by insurance. So for example, when a flood destroys a neighborhood and the total damage is, say, $1 billion, but only 300 million is insured, then the rest, the 700 million, that's a gap that falls on households, businesses, and ultimately on governments who end up footing the bill through unpredictable and slow relief, which can delay recovery for years and impact economic growth. So what's striking about protection gaps is their scale. For example, to give you a number, between 1980 and 2024, natural catastrophes have caused nearly $7 trillion in property losses, and only one third of that, was insured. So now those protection gaps, they exist across many domains. They're also very big in health, in pensions, and they're also equally important as disasters in terms of being societal challenges. But the report that we published focuses specifically on disaster risks. And there we'd like to highlight three areas of concern where those gaps are significant or growing, which is natural catastrophes, cyber risk, and also pandemic-related business interruption. So for natural disasters, like I said, the protection gap is around 2/3, 60% of economic losses, but this hides large variations across regions and perils. For example, insurance penetration is typically high for windstorms in advanced economies, but much lower typically for floods or earthquakes. And overall is extremely low for all perils in emerging markets. I mentioned cyber risk. It's another rapidly growing protection gap. It's very hard to quantify that gap, right? To put a number on it. So we can only have wild guesses. But what we know for sure is that only a tiny share of those losses is currently insured. And this gap is concerning because of what we call in insurance systemic risk. For example, we are all using a very small number of digital tools. So a single attack through those tools could target a tremendous number of businesses at once. And so the consequences could be very large and ripple through the economy and wreak havoc. And the third example I used is pandemics, which also represent a third major gap. So the COVID-19 crisis, as we all know, showed that business interruption losses can reach extremely large levels during pandemics, and that goes far beyond what traditional insurance was designed to cover. So most of those losses fell on firms, workers, and ultimately governments rather than insurers. So together, these risks, they illustrate this big challenge that economies are evolving, new systemic risks are emerging, but insurance coverage is not always expanding at the same pace.
So what are the primary drivers behind the widening gap between economic and insured losses?
Yes, I highlight three drivers in this report. And the first is on the loss side. It's simply that the losses or the risks, if you want, are just getting bigger. For example, climate change intensifies natural hazard. We also see on the level of exposure, urbanization is concentrating assets like homes and buildings in exposed areas. And for cyber, for example, digitalization is creating new cyber exposures. You can even think of, let's say, an attack on the computers that are used to set up pacemakers before they're implanted in patients. That sounds like science fiction, but the risk is there. We can also think of aging infrastructure and weak building codes in property risk, which are making exposures more vulnerable. And in cyber, we can think of insufficient cybersecurity measures. So the underlying risk is growing faster than our ability to cover it. The second driver is on the demand side. So many people underestimate the likelihood of those rare but catastrophic events like a flood or a storm. And there's this documented behavior bias, which that if something hasn't happened recently, people will just assume it won't happen to them. Other people also may just expect the government to pick up the tab, which reduces the perceived need to buy insurance. And also simply for low-income households, premiums can simply be just unaffordable. And then we have the final driver, which is there on the insurance supply side. So for insurers, there are challenges when they have to cover disaster risk, which are highly correlated. They will happen all at once across several policies. And so the losses can be enormous. Or they can also be deep uncertainty, for example, around cyber. We don't really know how to quantify the scale of those losses. So this pushes up capital requirements, which increases premiums, which in turn can further suppress demand. And cyber risk is a great illustration for this. We have difficulty modeling the losses because we don't have much data on large incidents. There is a high risk of accumulation. So it's very difficult for insurers to diversify as well. And so because of this potential scale and this high uncertainty, insurers can limit coverage. They can impose exclusions. They can impose policy limits as well. And as a result, many cyber losses are simply uninsured. And there's another aspect, which is in some markets, especially for NatCats, there can be price regulation. And this can really make the situation worse because by capping what insurers can charge, which can ultimately drive them to withdraw insurance altogether, the price does not reflect the real risk. And we have seen that in California for NatCats, for example. So you really have this multifaceted problem with rising risks on the one hand, reluctant demand, and also a constraint on the supply. And this is this combination that is why those gaps are so persistent.
And how does your report define effective public-private collaboration in the insurance context?
Okay, so my definition would be that public-private collaboration is effective when the state and insurers work together in a rules-based way. And that means that each take the part of the risk that they are best equipped to handle. So these are formal arrangements set in law and regulation where responsibility is shared for the risks that neither party, neither the state nor the insurance industry can manage alone. But we're very deliberate here about what we mean by effective. So we define it around three outcomes. The first one is, does it make coverage available or more available? Does it make it more affordable? And also, does this coverage actually get taken up? But then we also define effectiveness by what I call the 4 guardrails that such program must stay within as much as possible. And these are the fiscal guardrail, meaning that we don't want open-ended burden on public finances. Importantly, also the market guardrail, which is that the public-private insurance program should not crowd out private capacity and should not also override market discipline. There is a social guardrail, meaning that the coverage that is offered should be fair and also protect the most vulnerable. And finally, the operational guardrail, which is that the program should be operationally efficient, paying claims quickly and also adapt to the fast-changing risk landscape. And so in this report, what is really nice is that we had an analysis of 14 such programs worldwide. And our analysis has shown that many programs have genuinely succeeded in terms of making coverage more affordable, more available, or boosting uptake. We have seen incredible numbers in France, in Spain, in New Zealand, which have achieved near universal coverage. So it means almost the entire population is covered for those risks that the PPIP protects against. But many of those have stretched those guardrails that I mentioned. So they have accumulated fiscal strain. Some have distorted private markets. So really effective collaboration is not just about coverage levels, but it's also about designing for a meaningful interaction between your objectives and the guardrails.
Where are you seeing successful models of public-private partnerships that could be replicated elsewhere?
Yes, that's a great question and also a very difficult one. So I would like to push back slightly on the word replicated because those programs, they are really deeply context dependent. That's really important to bear that in mind. And there's a temptation to transplant a program. For example, there's a recent proposal in Germany that is heavily inspired by the UK program Flood Re. And you can understand why Flood Re has genuinely expanded coverage, But also Germany has a different legal system, a different market structure, different customers, and also a different flood exposure pattern. So what works in one context doesn't automatically transfer to another context. That being said, some programs have stood out in the analysis. For example, for terrorism risk, Pool Re in the UK is exemplary, in my opinion. It has managed to restore private capacity after a terrorist attack and a capacity crisis. It keeps the state as a pure backstop, only absorbing the highest level of losses. And it has also built massive capital buffers, which is now protecting the UK government. On top of that, the UK government is actually monetizing this protection because it's being paid for offering a state guarantee. So now in the UK, you have a well-protected economy against terrorism, and it has cost nothing to the Treasury, which has actually monetized this guarantee. So that architecture, in my view, is really worth studying carefully. But it's about terrorism risk, and this is not like cyber or NatCats. So this model maybe cannot be fully replicated for other perils. If we think of NatCats now, I'd be more cautious about a single so-called perfect model. What travels well, though, is what I mentioned earlier, which is this analytical discipline. And by that, I mean the clarity about the trade-offs. So the framework I just described identifies those 4 guardrails, and a PPIP typically will push on at least one of those guardrails. So the design has to reflect a political choice about what are the objectives in terms of coverage, availability, affordability, but also which of those guardrails, whether fiscal, market, or social, you are willing to stretch. And to give you examples in the NatCat area, if you take France and California, they've made widely different choices. So France has a so-called NatCat scheme, which is heavily pushing on what I call the fiscal and the market guardrails, because the state is very significantly exposed, and it has also crowded out private capacity, meaning that it is visibly insuring losses that could be privately insured. But it has a very strong social guardrail. There was a price to pay for near universal coverage at a flat rate across the entire population, which was a clear social choice. And on the other hand of the spectrum, you have California and the Earthquake Authority, which has made the opposite trade-off. So it's very aligned with market discipline. It uses risk-based pricing, for example. It has voluntary coverage, which means that, unfortunately, coverage can remain relatively low, particularly in high-risk areas. But it's a very disciplined scheme. So the honest answer, in my view, is that there is no template to copy, but there's a framework for thinking clearly about what do you want to prioritize when designing such a scheme.
Customize your data experience. BestLink now offers an interactive company dashboard that provides company-level intelligence in a fast, user-friendly interface featuring interactive tables, charts, and Sparkline performance histories. Customize the dashboard tiles to prioritize the insurer ratings, data, and analytics that best support your workflow. AM Best. Our insight, your advantage.
Hélène, is there a role that government should play in making emerging risks more insurable?
Yes, there is. And it's a question we address directly in the report. So government needs to be proactive, in some cases much more proactive than they are at the moment, but they need to be so in what I would say a disciplined way. So the instinct is often to jump straight into a public-private partnership. But in the report, we argue that that should be, in fact, the last resort, as there are more efficient levers for the state to pull. The first one needs to be risk reduction, so lowering the level of economic losses. For example, in the cyber domain, it's about strengthening cybersecurity and security standards. For climate, it can be about better land use planning, better building codes. So insurers can only price risks that are reasonably well understood and which are bounded also economically. So we need to reduce the losses first. The second lever, I would say, is lighter touch interventions in the market. So strengthening private markets and their mechanisms. So it could be through better risk data, through awareness campaigns to try to improve the demand, and also by using regulation that doesn't inadvertently suppress coverage, like the premium caps I mentioned earlier. So once you have those two pillars in place, reducing risk and supporting private markets, then if that is not enough to narrow a given protection gap, then governments could indeed consider public-private partnerships. But even then, the state's role should really be to be a reinsurer of last resort, meaning that it covers only the tail risk that private markets genuinely cannot absorb. So you asked about emerging risks specifically. So if I'm thinking about cyber or pandemic, our conclusions there, however, are quite cautious regarding PPIPs. So for cyber, a backstop for systemic tail risk may be justified, but there's so much ambiguity around the actual cost and distribution that it's very hard to design a PPIP, which leads us to believe that the government really should focus on the first pillar on risk reduction and mitigation, and also on strengthening private markets first. If we think of pandemics, then we're even more skeptical about the PPIP option, because the risk is so large and correlated that any scheme would really be mostly a fiscal instrument of public support with perhaps some kind of insurance wrapper around it. And so policymakers should be also honest about what is possible.
So how would you say PPIPs could be designed without crowding out private capacity, stifling innovation, or distorting insurance markets?
Yes, that's $1 million question. So that's what I call the market guardrail. And it's really one of the most common failure modes of such schemes. So the problem is that the state often ends up competing with the private market. And France, I've mentioned it already, is actually a bad example here, because CCR, the state reinsurer, now covers the majority of catastrophe reinsurance in the country. And so the state guarantee has crowded out private reinsurers, and the result is potentially less innovation and also growing fiscal exposure for the state. So the core design principle to bear in mind to avoid this is to keep the state strictly as a reinsurer of last resort and not of first resort. So it means the state should only cover the loss layers that the private insurers and reinsurers can't absorb. So that's the extreme tail of any distribution. So this crowds private capacity in because they know now that the catastrophic scenarios are backstopped and they feel comfortable underwriting the lower losses. And beyond that, I would also add pricing discipline is very important. When a PPIP uses flat rates, so-called solidarity pricing, it can really dull the price signals that can encourage businesses or homeowners to reduce their exposures.
In areas like climate and cyber risk, Hélène, what specific barriers are preventing broader insurance coverage?
Yes, so across different types of risk, they look quite different. For climate, I would say that the largest barrier is currently demand. So many people, I've mentioned that earlier, don't buy insurance because of, say, behavioral biases or expectation of government relief because they've never experienced a loss themselves. So this is really a structural problem. And no amount of supply side intervention like capital regulation, etc., could fix demand really. It's really more about raising awareness. But if that fails, perhaps it's time to think also about what some schemes do, which is to make coverage mandatory. If we think of cyber risk, so the big emerging risk on the horizon, the barriers here, I would say, are more fundamental. The challenge is that we don't have a good empirical basis for estimating the cost of a systemic event. So that can even create situations where insurers, without knowing, can take on cyber exposure through standard policies. So that's what is called silent cyber. And we've seen that during the NotPetya event in 2017. So in cyber, the boundaries between what is and isn't being insured are even unclear, which is a serious systemic concern.
Hélène, do you think PPIPs can be designed to better signal risk and encourage prevention behavior rather than simply absorbing losses after disasters?
Yes, I think they can. That's an optimistic message that I want to carry. But if we look at the existing programs, too many of them have been designed as financial mechanism to share losses, and their creation was triggered after a disaster. And so in those schemes, prevention is really an afterthought. So the most striking example is the US National Flood Insurance Program. It provided for decades subsidized insurance, which makes obviously coverage affordable, but it also encouraged people to keep building or staying in high-risk floodplains. And so this has really increased the very risk that the scheme was meant to cover. So there are ways of avoiding this trap, and the report suggests several concrete mechanisms. So the first one I've said already is risk-based pricing. It should really be the default whenever possible, because risk-based prices send a signal about where it is safe or not safe to build. The other way that it can be done also to sort of boost prevention is to embed incentives into the design of the product that those schemes are selling. So, for example, some schemes offer premium discounts for individuals who retrofit their homes. They can also, after an event, cover the cost of building back better so that the home becomes more resilient to the next event. The problem with this approach, though, is that it's only focused on individual exposures, like your home or your plant. And those individual measures, they only go so far. And so for lots of risks, such as floods, for example, the biggest lever is actually government infrastructure investments. So a PPIP cannot incentivize the building of a dam for a flood, for example. So really, those schemes, they cannot replace policy decision about where to build a given infrastructure or regulate land use planning or building codes, for example. So if we don't have that connection between the prevention that is done at the collective level by local or national governments and the PPIP, then we risk having this problem of the scheme making the problem worse, in fact.
Last question, Hélène. If policymakers and industry leaders take one key action from this report, what should it be?
Yes, one key action. I think it would be this. Not treating PPIPs as a substitute for risk reduction, but designing them, and if you're considering designing a new scheme from scratch, embedding it from the beginning as part of a broader national resilience strategy. So the default logic has been reactive, right? A disaster happens, a PPP is created in a crisis mode. Now we really need to take some time to have a different decision-making sequence. Have we exhausted all the risk reduction measures that could be taken? Is there a clear fiscal case for a PPIP? And then if we have a PPIP, what are we willing to trade off? Are we willing to push the social guardrail, the market guardrail, the fiscal guardrail? There's a big caveat, though, which is that many measures that I said we should do first, like building codes, that can take decades to have a material impact. You can't remove the badly built houses overnight, right? So maybe you build the new ones better, but you still have that old housing stock that is there on it at risk. So in that case, there may be a need for a PPIP to manage a transition for the period where we still have homes that are exposed. But the goal should still be to reduce the risk upstream first and have a PPIP as a last resort solution. But I would also want to add, and policymakers, we know that the window for getting this right is really narrowing. The risks are growing across the globe. In many countries, public finances are stretched. But there is a good news. We now have experience. You can see in the report with the analysis of several PPIPs, we know what works. We know what doesn't work. So what is needed today is really a political will to apply this framework of decision-making rigorously.
Interesting report. Hélène, thank you so much for taking the time to speak with us.
It was my pleasure. Thank you, John.
That was Hélène Schernberg, Director of Public Policy and Regulation at the Geneva Association. And I'm John Weber for I Am Best TV.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.